All right. Hi, everybody. Welcome to our Understanding Today's Credit Landscaping webinar. We have a lot of really exciting things to talk about today. The world of credit is huge, and there are so many kind of ever-changing things. Credit impacts every single aspect of our lives, and trying to figure out how we can exist in a world where sometimes credit is not very friendly to who we are as individuals is really important. So welcome as you continue to trickle in a little bit of some housekeeping. Uh, we have two different methods of chat. So what you'll see in the bottom is we have, there's a chat area. And if you guys just want to use that chat to say hi to everybody, you'll see that Ali is in our chat. He's helping moderate that for us. And then my name is Megan. Myself and Ali are both community engagement specialists over here at Patelco. So we're going to be trying to answer all of your questions for Andrew. And that way he can focus on giving you all the good information that you're looking for. If you have questions that are related to today's webinar, please put them in the Q&A section. That way we can actually answer them. There's going to be a lot of questions today with credit. A lot of us have very specific questions to our own individual needs. So be flexible with us as we try to respond how we can, and we might reach out individually to give you some more support one-on-one. When you stick around to the end of this webinar, that's going to be great for you. We're going to be giving away 3 $25 Amazon gift cards. So hang out. We're happy to have you here. And on Friday, you'll see an email from us with the winners. It won't be spam. It will be a real gift card from Amazon for us. So we're so happy to have you here. A little bit about us. We are Patelco Credit Union. We've been around for 90 years, which is fun fact. This is our Julie Andrews birthday. We are the same age as Julie Andrews and Clint Eastwood. So we are happy to be here. We are happy to share whatever information and knowledge that we can to make life easier and sustainable living just more accessible to all. So we are so happy to have you here. Like I said, my name is Megan, and Ali is helping moderate the chat as well. So we have people to answer your questions. So with that, I'm going to introduce Andrew Farrell. He is our head honcho. He's in charge of all of our webinars and does a great job giving us all the information we need to be better with our finances. Andrew?
Thank you so much, Megan. And hello, everybody. Welcome back to our Patelco Credit Union webinars. I know we took a little break in June to give everybody some summer downtime, but we are happy to see you all back. I am happy to be back here. I missed you guys. Credit in 2026 is what we're going to be talking about today. Now, it is not the same system that people learned 10 years ago or even really 5 years ago. Scores nowadays are moving much faster. Lenders are looking at more overall behavior, and the rules around credit are shifting and evolving. So we are going to break down what's actually changing in the modern credit landscape. It's going to be a lot of information. I'm going to try to explain all the technical terms to the best of my ability, but if you have any questions, like Megan said, please use that Q&A feature, or please feel free to shoot us an email at webinars@patelco.org. So a little bit about me for those of you who have not attended a webinar with me here before. My name is Andrew Farrell. I am Patelco's financial well-being educator. I've been with Patelco for almost 9 years now, but I've been in this role specifically as the financial well-being educator for only about 8-ish months. Before that, most of my work was in the branch. So I worked at the Concord branch for a while. I worked throughout the Sacramento region at those branches as a regional team lead. I also worked in community engagement. So the same role that Megan and Ali are doing, I worked in that doing events, festivals, all that fun stuff, getting the word out there about Patelco. But I feel like I've really found my niche in this role here. I love information. I love sharing information. I will regularly go down like Wikipedia rabbit holes just for fun. I take this information that I amass and I also host a trivia night every Tuesday. I talk about this every webinar that I host. So if anybody is in or around the Oakland area, Mad Oak Bar in Oakland, every Tuesday at 7 p.m., I host a free trivia night. It's fun. Bring your friends. You can win some free drink tokens. You can maybe go home with a shiny gold medal, and you can listen to me talk some more. So it's a win-win for everyone involved. All right. I like to start my webinars with a quote. So today I have chosen knowledge is power shared is power multiplied. I firmly believe that knowledge is, in fact, power. And today, what I am sharing with you all is just that. It's knowledge on how these credit systems work. I want to be very explicitly clear here just to set expectations from the jump. This is not like a credit tips and tricks webinar. It's not offering any kind of advice on credit building. Today is pretty strictly just informational with all of the changes that are happening with how credit is being calculated and how credit worthiness is being decided. But I feel like the more you know, the more informed decisions you'll be equipped to make. I did a ton of research on this topic, so you don't have to. I've put it all together in a nice hour-long presentation that hopefully you'll be able to learn something from. And then your job will be then go out and share what you've learned today with people in your circle who might benefit from this information. And that is how knowledge shared becomes power multiplied. Knowledge is power and sharing is caring. That is our motto for this evening. All right. I want to start with a quick review on what credit traditionally is, how it's scored, all of that, just to make sure everyone in attendance is on the same starting point as we move forward. So this might be a review for a lot of you, but I just want to make sure our baseline, we're all at the same starting line. FICO stands for Fair Isaac Corporation. They are who created this industry standard credit scoring system. I'm going to give you all a little history lesson here. Before this standard was established, it truly was the wild, wild west when it came to determining credit worthiness. Lenders relied on very subjective and very inconsistent methods to judge credit worthiness. I'm talking like they would conduct interviews and just judge your character based on how you were dressed or how you presented yourself. They would look at your marital status. They would look at if you've been divorced or not. People pre-FICO would be able to be approved for a mortgage with a letter of recommendation from their priest or their doctor. It was kind of all over the place. So Fair Isaac Corporation introduced the scoring model in 1989 with the intention of eliminating that bias. And then in 1995, Fannie Mae and Freddie Mac advised mortgage lenders to adopt the scoring system, which is what led to FICO really just blowing up and becoming the industry standard that it is today. FICO is now used by 90% of the top US lenders to evaluate consumer credit risk. Now, there are three credit bureaus that each produce their own FICO score. That is TransUnion, Experian, and Equifax. So if you ever wonder why your score may fluctuate when you check it, this is predominantly why. These are three independent entities that all use the same FICO scoring model to calculate your credit score, but there can be slight variations between them. For example, they might have different reporting cycles, meaning one bureau may hold more up-to-date account information than another one does. Also, creditors are not required to report to all three bureaus, so one might include data that others aren't reflecting. There's also different versions. There's FICO 8, there's FICO 9. We're going to talk about FICO 10T later, which includes a pretty significant change in today's modern credit landscape. But I like to look at this as you have three chefs, for example. Three chefs, they are each preparing the same recipe. They each have the same ingredients. Those three dishes, even though they're using the same recipe, following the same steps, using the same components, are still not going to be exactly identical because it's three autonomous, independent entities creating the recipe. That is exactly how these credit bureaus work. And they score you on a number of 300 to 850. 300 to like low 600s generally is considered not so great credit. Fair credit is normally up to like the high 600s. Once you get to 690, 720, 730, that's normally considered good credit. And then excellent credit is any number from there up to 850. And your credit score determines A, your approval odds, and B, what your interest rate will be upon approval of the loans that you're looking for. This is how they traditionally score your credit. So 35% of your overall credit score is your payment history. This is how often you miss payments, how recently you've missed them, and by how many days. So if you've missed one payment on an auto loan by 30 days 2 years ago, that is not going to weigh as heavily as if you are frequently missing payments as recently as this past month on 2 or 3 different credit lines by 60, 90 plus days. It looks at your behavior of payment history, not just, you miss one payment and your credit is tanked. 30% of your credit score is the amounts owed. This is the total amount owed on all loans and how much you owe compared to your available credit. So if you have $10,000 in total available credit. They want to look at how much of that total available balance you are actually utilizing. The sweet spot here is 30%, so it's 30% of your score. If you can keep your balances at 30% or less of your overall credit limit or your overall available credit, you are looked at as good credit utilization. If you can keep it at 10% or less, that's that extra sweet spot, but 30% or below, you're going to be in good shape. 10% is new credit, how many loans you've recently opened or applied for. This is just there as a safeguard. If you are applying for 10 credit cards in the span of a week, that can sometimes be looked at as like quote unquote red flag behavior. So it will ding your credit a little bit depending on how frequently you're applying for new credit. Length of credit history is the average length of time that you have had credit established. So they take a look at how long you have had existing trade lines and put an average of all that time together, and that determines your length of credit history. When people say that it's not a great idea to close your oldest credit card, this is what they are talking about. If you have a credit card that's been open for 10, 15 plus years, and it's the first credit card you got, that credit card is your anchor. That is the thing that is holding your average down the longest. So you ideally would like to keep that open to extend your average length of credit history. And then last is credit mix. This means you have diverse types of credit, home loans, auto loans, credit cards. This is also only 10% of your credit score. It's not weighed super heavily. It is a smaller factor, but this is just there to make sure that you are able to handle different types of debt, revolving, installment, what have you, all responsibly, and you're not just throwing everything on credit cards. So this is traditionally how credit is done. But I am going to talk about how credit scoring is changing. It is using pretty much those same models, but there's a different additional like variables and things like that that are kind of changing the way that your credit scores are calculated or your approval odds are changing. So first is new models. This does not mean that there are new FICOs that are out there, but there are updated scoring formulas. So when I mentioned earlier, there's FICO 8, FICO 9, those different score versions. This is what I'm talking about. These updated credit scoring versions include what is called trended data, which we will get into here in just a moment. But these formulas are now essentially looking more at your credit patterns over time, as opposed to just what they are at a single moment in time. So for example, do your balances trend up or down on your credit cards? Do you pay in full often, or are you only making minimum payments? Are you gradually taking on more debt as time goes on? Those kinds of behaviors are now what's being monitored in these new credit scoring models. They're looking at new data. So this refers to new types of information either entering your credit report itself or being factored when lenders make credit decisions. So before it was just the scoring factors that we talked about on that last slide. But now, increasingly, things like rent payments and buy now, pay later loans are being able to be reported. They're not always automatically reported, but there are growing ways where these variables can impact either your score itself or your lendability, which we will also talk more about later. And then finally, we have new tools. So this refers to the lender side technology that uses alternative data outside of the traditional credit report to understand your financial stability. So rent, cash flow, these things can also come into play here. Even if something is not directly reported onto your credit report, lenders nowadays are able to use that data that exists outside your credit report to get kind of a clearer idea of what your current financial capacity is. So I know that was a lot. We're going to break all this down in more detail as this webinar chugs along, but I wanted to start by providing you all with kind of the overview about what's going on right now in today's evolving credit landscape. We're going to start with the first part, which is new models. Now, these new scoring models are using what is called trended data, which I talked about. So trended data shows your current credit utilization behavior and patterns over time as opposed to at one singular moment in time. So without trended data being calculated, your credit score was essentially based on just a single snapshot. Credit scores would be calculated by taking whatever was on your credit report on the day that that credit scoring model pulled the report and scoring only on that one moment. So if your balances were super high that day, then that would be reflected as high balances. If your utilization happened to be really low that day, your score reflected really low utilization. Each individual snapshot every month was essentially a fresh photograph. It overrode the previous one. So the scoring model would not compare your last snapshot to your current one. Credit scores were based specifically on just a single moment in time. Trended data looks more like a highlight reel instead of a snapshot. So it takes into consideration your patterns over time as opposed to just like right in that one moment. Lenders are moving to trended data because it's generally able to predict risk a lot better than the old snapshot system was, and there is several reasons why that is. Number one, the snapshot model is very easy to game. So, for example, if you carry a really large balance on your credit card, people theoretically could pay the balance down right before the statement closing date, which is when your balance does report. They would have their utilization then look perfect for 1 month. They would apply for whatever credit they needed to, and then just immediately run the balance back up. With trended data, that behavior now becomes a little bit more visible. Direction, whether you're trending up or down, tells lenders more than what a singular number can tell them also. So, for example, a $3,000 balance that is trending down, meaning like you're paying down the debt, that looks different than a $3,000 balance that's trending up. And lenders want the ability to distinguish people who are paying off their debts from perhaps an emerging risk instead of treating them all the exact same because their numbers are reporting the same way. And then to build on that point even further, trended data allows scores to move faster when someone is trending upward or downward because lenders are now more concerned with what your financial patterns are right now, as opposed to what mistakes you may have made, or perhaps how good you may have been, 2 or 3 years ago, if that behavior is not indicative of your current habits. So here specifically is what trended data is looking at. Like I said, they're looking at the balance direction. So whether your balances are trending upward, downward, or if they are staying stable and consistent over a certain period of months. They're looking at your payment style. So whether you usually pay in full, whether you pay more than the minimum, or you rely only on minimum payments. Somebody who pays their balance in full every month versus someone who only makes their minimum payments, again, theoretically could have the same score based on other factors without taking trended data into consideration. But this new trended data model will reflect the payment style, which can kind of help move the needle one way or the other. They're looking at utilization patterns. So whether you hover near your limit or you spike usage or you keep it consistently low, how do you generally utilize your balances over time? Spending volatility is whether your monthly charges swing wildly or do they stay predictable and consistent. Debt accumulation, whether you gradually take on more debt or do you steadily pay it down. So like I said, trended data that shows a $3,000 balance that is slowly being paid down is now going to look different than a $3,000 balance that last month was $2,500 and the month before that was $2,200 and the month before that was $1,700, so on and so forth. They look at balance cycling. So do you carry balance month after month or do you regularly reset to zero or keep your balances paid down low? Payment timing shows if you pay early, if you pay on time, do you frequently cut it really close? Are you always paying like on the last day of your 10-day grace period? If so, it is not going to tank your score, right? Like you're still in the grace period, but it is a pattern that is now going to be visible. And then they're also looking at credit seeking behavior. So are you opening accounts in clusters or are you spreading them out over time? These are all things that are being taken into account with trended data when they are calculating your score using these new credit scoring models. So essentially, trended data is saying the direction you are moving in matters just as much as the current position that you're in. So now I want to talk about these new scoring models that are using this trended data. And that is going to be Vantage 4.0 and FICO 10T. So these specifically are the new scoring models that are utilizing trended data to calculate your credit score. You'll notice here, FICO, we've talked about. Vantage is something that's kind of different. So before we talk about these specific scoring models, I want to talk about what exactly Vantage is and how it differs from FICO. So FICO, like I said, is the legacy model that is used by lenders since the late 80s, the early 90s. It is the main one, right? 9 out of 10 times lenders will be pulling your FICO score from one of the 3 credit bureaus. FICO requires 6 months of credit history in order to generate a score. And the reason that is because FICO is more risk focused. It was built with the priority of avoiding any kind of loss as opposed to like expanding access to credit. The design philosophy around FICO is to have potential borrowers prove that they're safe and that they're reliable borrowers, which is why it requires 6 months of history. It wants a long and stable track record before essentially it trusts you. Vantage was introduced in 2006, and it was introduced as a joint venture between the three credit bureaus, Equifax, Experian, TransUnion. They all produce a FICO score using the FICO scoring model, but they all have all this data they have accumulated over the years, and they wanted to make credit scoring more inclusive. So essentially, the three credit bureaus who all generate their own FICO score came together and they were all like, look, we have got all this data, but there are so many people that we have data on who are quote unquote unscorable under FICO's rules. Either their credit profiles are too thin or they don't have 6 months of history or whatever it is. So they decided to all come together, pool their data, and create their own scoring model where they don't necessarily have to follow FICO's strict rules. So now they are able to monetize all this data, which is great for them. They can give Vantage scores after only 1 month of history, which is great for consumers. And then they made it to adjust more quickly and more flexibly to the actual behavior that it sees. Vantage also weighs things differently. So, like credit mix, for example, we talked about how FICO likes to look at having different types of credit, mortgages, auto loans, student loans, things like that. Because Vantage Score was designed to score thin files and newer borrowers, it can't really afford to like quote unquote punish people for not having a mortgage or an auto loan. So it adapts to whatever data exists and evaluates behavior more than like having a really diverse portfolio. So Vantage is used a lot for soft pulls. It's also used a lot with like fintech lending. So buy now, pay later, cash flow lenders. It's used a lot with like marketing and pre-screening and credit card pre-approvals. A lot of the stuff that takes place upstream of the final loan decision will use a Vantage score because it reacts faster and thus reaches more people. So whereas FICO tends to be like the final decision metric, Vantage still comes into a play a lot when determining creditworthiness. Now, specifically, FICO 10T and Vantage 4.0, these are the first mainstream, nationally used consumer credit scoring models to formally incorporate trended data into your actual credit score itself. So as of 2026, Vantage Score 4.0 is currently widely used for things such as pre-approvals and fintech lending. FICO 10T is still in very, very early adoption. And I'll give you kind of a timeline here for this. So most major lenders are still currently using the older models of FICO 8 and FICO 9, but the mainstream shift to FICO 10T will happen when the mortgage industry adopts it. That's how FICO became a thing in the first place. Mortgages drive the entire credit ecosystem. So when mortgages say go ahead, everyone else follows. The FHFA, which is the Federal Housing Finance Agency, has mandated the transition to move to FICO 10T, but the rollout is going to be like a multi-year situation. So the real transition will likely happen around 2028, 2029, and then the rest of the lending world will follow suit after that. All right, so now that we have discussed the scoring models, I want to talk about the new data that is being included because there's a lot of talk about how things like rent and utilities and buy now, pay later, BNPL, and all those other variables are starting to impact lendability in your credit scores. So we're going to start by talking about rent reporting. Rent is increasingly being used as a factor when considering credit behavior. The reason for this is that lenders want to give consumers a more accurate and accessible chance to prove that they can handle making payments. The idea here is if you are paying your obligations responsibly, that should count for something. And a lot of people who are renting maybe don't have credit cards, maybe they don't have auto loans, they have thinner credit profiles, but they make their rent payments on time every month. And that does show responsible payment history. So the credit bureaus and the lenders are trying to find a way to get that information and that data to count with your credit scoring, your credit worthiness, all that good stuff. Now, your rent payments can be used when determining whether you'll be approved for a loan or not, because it can be used as what's called alternative data, which is stuff that's outside your credit profile. And we will talk more about that here in a moment. But if we're looking at how rent can be reported to the credit bureaus and actually impact your credit score, there are currently three ways where that can happen. First, and by far the most rare, is automatic reporting through your landlord. This is where your landlord themselves is submitting your rental payment history directly to the credit bureaus, the same way a financial institution would with, say, an auto loan or credit card payments. This is extraordinarily rare, so rare that I almost did not even include it in this deck. But there are some very big property management companies who will do it. For the most part, though, most rent in the US is managed by small or like mid-sized landlords. And those landlords just don't have the systems, they don't have the compliance infrastructure. Quite honestly, they don't really have the incentive to automatically report your rent. So it can happen automatically, but it's quite rare. Next, and probably the most common way that rent gets reported is through third party services. Now, there are some platforms that renters can opt into themselves where you are essentially reporting your own rent every month to have it count towards your credit profile. You submit your payments through these systems, they verify your payments, and then submit them to the bureaus as a trade line, like any other trade line would be submitted. These right here, Built, Broom, Susu, Rent Reporters, are some of the most popular rent reporting services that are out there right now. There's also Pinata. There is Rental Karma is another one. These all accomplish the same thing ultimately, but they all work a little bit differently. So some of them, for example, might require like a landlord verification. And if your landlord is not opting into that, then you wouldn't be able to use it. Some of them don't require landlord verification, and you would just like link your bank account and it would look at your payments. Some of them you have to provide like check images if you pay that way. Just be up to you to kind of look into what the requirements are and find a service that works for your situation, should you choose to pursue something like this. But it is a way that you can have your rent reporting. It just requires you to essentially do it yourself. And then last, this is kind of a tie-in to the previous one, and that is by using rent payment apps. So some landlords will use apps to collect their payment, like you pay the landlord directly through the app. And even if the landlord themselves is not directly reporting your payments, if you use these apps, then the app will automatically report the payment to their credit bureaus. Built Rewards down here, they are one that does this. This is great. Not a lot of them do this, but it's great if it is available to you because you don't have to manually verify your payments each month, but it's only accessible to people whose landlords accept payments through the apps that offer this. So this is how rent can be reported. Another new piece of data that is increasingly affecting credit reports is buy now, pay later, or BNPL. So for those of you here who have never used this service or are unfamiliar with what it is, BNPL loans are short-term installment plans that are offered at checkout when you are making a purchase. It's offered a lot on online purchases, but it's showing up a lot more regularly now at physical retail as well, because that's where a lot of volume is. The most common type of a BNPL loan is a pay in four model. So it just breaks your payments up into four even installments, usually at 0% annual percentage rate or APR. But longer installment loans are becoming more common here as well. These longer installment loans sometimes are at 0%, usually if it's a payment plan offered directly from the store itself. But if it is offered through a buy now, pay later company, the 0% that shows up on those short, cheap paying for options generally are not going to be there for the 12, 18, 24-month loans because it's just not as financially viable. Now, these are some of the big companies right now that are in the BNPL game. So when you're at checkout and you're looking at your payment options, these are some of the more common ones that you're going to see. BNPL technically is credit, right? Like it's borrowing with the intention of paying something back with a set of terms, but it's not regulated like traditional credit is. And historically, it hasn't been reported to the credit bureaus. That is beginning to change in a couple different ways. So currently, at this time, BNPL has four different reporting behaviors. The first is full reporting like any other credit line will be reported. This means that the BNPL providers are sending the full trade lines to the credit bureaus, the loan amount, the payment schedule, the on-time payments, the missed payments, all the nitty-gritty is being sent to the bureaus. Affirm does this for a lot of its longer installment loans. Klarna is doing it for some product. Apple Pay Later is beginning to report. This is a newer one, but it's starting to roll out. When BNPL is reported as a full trade line, then the credit bureaus treat it like any other installment loan. This is becoming increasingly more mainstream. Regulators really want this to be standardized. The credit bureaus have built-in frameworks that can take this. So as time goes on, this method of reporting for buy now, pay later is trending in the direction of reporting like any other loan would report. There's also negative only reporting. So some BNPL providers only report missed payments or defaults and do nothing with your positive payments, which is the worst case scenario for consumers, unfortunately. And it should not be a thing, but unfortunately, this is the world we live in. If you pay on time, this is essentially saying that it will do nothing to build your credit. But if you miss a payment, it is both visible and damaging to your credit score. It's unfortunate, but that is one method that they can theoretically report if they so chose. There's also what's called specialty bureau reporting. So some BNPL providers only report to what's called specialty bureaus. Specialty bureaus are essentially alternative credit bureaus. They specialize in like thin file or non-traditional credit data. Clarity Services is one that's owned by Experian. I think Factor Trust is owned by TransUnion. If BNPL is reporting only to the specialty credit bureaus, then it's not going to show up on your credit report. It will not have any impact on your credit score. But if you are working with a lender who subscribes to those specialty only bureaus, then they will be able to see your BNPL behavior. And then last but not least is no reporting at all, which may sound super easy, but there is what's called a hidden debt problem with that, which is where buyers can buy and stack multiple BNPL loans across all these providers, and lenders cannot see what's going on. So individuals can keep getting greenlit for these like micro loans because there's like no reporting to show their existing BNPL obligations. And then they end up in a situation where they just cannot pay back all these loans and can incur a bunch of fees and potentially have their debts sent to collections. And that is just no bueno. So that is essentially how BNPL right now is working in today's credit landscape. I will say this, I want to plug this. If any of this BNPL talk is of interest to you, I would encourage you to listen to an episode of our podcast. Our podcast is called Small Talks for Big Change. We did an episode that was released on March 24th of this year. It's called BNPL, Smart Tool, or Spending Trap, and it is hosted by our VP of Cards and Direct Consumer Lending, who is a BNPL expert, as well as one of our enterprise certified financial specialists who deals with the member side of this a lot. And we just had a really thorough, engaging discussion about the ramifications of BNPL, how it started, the direction it's going in, the good, the bad, all of it. I would certainly recommend checking it out if this is of interest to you. You can find our podcast on Spotify, Apple Podcasts, or I believe on Audible as well, whatever podcast platform Amazon uses. And again, the podcast is titled Small Talks for Big Change. The episode is called BNPL Smart Tool or Spending Trap. So go check that out. All right. The final thing I want to talk about here is the new tools component. So one of the biggest ways that these new underwriting tools are able to affect our lendability is by incorporating what is called alternative data. So alternative data means any type of financial related information that can be used either to judge risk outside of what is actually reporting to the credit bureaus or judge your ability to pay things back on time. This is all stuff that is not reporting on the credit bureau, not showing up on your credit report, but can still be used when making a lending decision. So this means that when you're submitting a loan application and it goes to underwriting for them to review whether or not they will approve you, they can, number one, of course, review your credit report, your credit score. But now there are ways where they can look at other things that are not showing up on that report, but still shed some light into your viability. So again, just to reiterate, these things are not affecting your score, not showing up on your report, but they are things that lenders can look at when underwriting your credit applications. We are going to talk about how alternative data can be used or how it can be accessed here in a second, but these are some of the things that can be used as alternative data. So first we have rent. We talked earlier about how rent can sometimes actually be reported to the credit bureaus, and that is great if it is. But if it's not reported to the credit bureaus, you can still opt in certain instances to have it be looked at when a lender is reviewing a credit application. It won't affect your score, but it's still a factor that they can judge. Utility payments, electricity, gas, water, trash, phone, internet, the bills that hit every month and show how you manage your basic obligations, that can be used as alternative data. Subscriptions, again, recurring, predictable payments like your gym membership, your Netflix, your Hulu, your Disney Plus, your Apple TV. If you are anything like me and you watch a concerning amount of television and movies, those can certainly prove some sort of financial capacity, especially for myself, considering how many of these streaming services I am regrettably paying for. Your buy now, pay later loans, just like rent, even if they're not reporting to the credit bureaus, they can still be used as alternative data. Bank account cash flow, things like regular deposits, your spending consistency, your overdraft frequency, your average balances, all of that now has the capability to be looked at when underwriting your loans. And then lastly, public records that help kind of signal whether you are a real stable person with a consistent footprint. These are things like employment verification, address history, stuff like that. A lot of that can also help combat fraud, which is also a really great kind of bonus. Okay, so that is the examples of what alternative data are. Now, how can this actually be used? One of the most popular ways consumers are incorporating this alternative data is by opting into what is called Experian Boost, which you might have heard of, you maybe haven't. What Experian Boost does, it is allows Experian and Experian only to pull certain recurring payments from your bank account and drop them into like a special section of your Experian credit profile. So it does not touch Equifax and TransUnion, and it's only Experian. TransUnion and Equifax do not offer anything like this at this time. It works by having you connect your bank account and then it scans your transactions for any eligible, consistent, recurring payments. So, again, utilities, phone bills, streaming services, that kind of stuff. This consistent on time payment that it finds will then get added to the boost only section of your Experian credit profile. So, it is not reporting as an actual trade line the way that a credit card payment or an auto loan payment would have. It is also not weighed as heavily. It's just kind of like this special extra thing that's there. And it is ultimately using what is hopefully positive data to reflect towards your Experian profile, which thus will help boost your Experian score just a little bit. It likely will not drastically improve your score, but it might help. Now, if you are interested in this, Experian Boost is free to opt into. So you can sign into your Experian account or you can create one if you don't have one already and go to the boost section in your account. You just connect your bank that you are using to pay for your utilities, your rent, whatever it is, and then it will get reported to this boost section of your Experian profile. One caveat here, and this is kind of annoying for me, it's got to be a bank account that you link. So if you make those payments with a credit card, which for myself, that is how I make my utility payments because I earn the points, it's great for that area, but unfortunately, Boost is not compatible with credit cards. So I won't be able to verify them. It's got to be linked to an actual bank account. All right. The other and increasingly more prevalent way that alternative data is used is through more advanced loan underwriting. And one of those ways is AI underwriting. Now, before we get into this, I know a lot of people have strong feelings one way or another about AI. I totally get it. I myself feel a type of way about it in certain capacities. Right now, I just want to focus on what these AI systems are doing in lending today so that you are all aware of how it's being used in today's broader lending ecosystem. Again, that is the point of this webinar, is to just arm you all with information. So AI underwriting means that lenders are starting to use these machine learning models to aid in the process of evaluating risk when consumers apply for credit. AI underwriting, like regular underwriting, it can use regular, traditional, and now trended data, but it can also look at that alternative data we talked about. So cash flow, stability signals, all of that to make a more holistic approval or decline decision for you. I want to really emphasize here that AI underwriting is not replacing human underwriting, especially when it comes to decision making. Humans are still making the judgment calls, they still set the policies, approve exceptions. There are instances, and this is like way pre AI, where the system will automatically decline or approve a loan based on your credit profile. So, for example, if someone has, we'll say, an active bankruptcy and like five charged off credit cards and $10,000 in collections, and then they go and apply for a $50,000 personal loan, the system will likely automatically decline them, AI or not. But if a loan application needs to be reviewed, that will still be done by an actual human person. The reason that a lot of lenders are utilizing AI underwriting tools is to help with all the like manual data crunching, repetitive parts of underwriting. There's a lot of pattern recognition work that AI can do super quickly that can help not only with getting your decisions faster, but also with giving you either better or like more nuanced approval logs. So AI underwriting, for one, can read thousands of data points instantly. Whereas if I were to sit there and review a loan application and manually scan trended balances, BNPL patterns, cash flow signals, overdraft history, cash flow, all that stuff, it might take me a little bit. It might take me a little while and you might take a little bit longer to get your decision. A robot, on the other hand, can do it like that. That's what they're designed to do. It can also provide more nuanced approvals because it is not relying on a single cutoff score. So, for example, if someone's score is like borderline, but their cash flow is really strong, or it's like trending again in one direction or the other, the AI models can see that at a speed and consistency that is universal. It can fill in the blind spots. It can evaluate thin file borrowers by using the alternative data that we spoke about earlier. So, people who perhaps used to be invisible, quote unquote, to lenders, now suddenly have enough data to be reviewed and potentially approved by an actual human. And then we also touched on this in the last slide, but there's some really useful fraud detection in AI underwriting as well. Things like mismatched addresses and like unusual spending activity are things that AI can detect. Also, things that humans can often detect as well. But beyond that, there's stuff like your IP address being inconsistent or being from a different location than what you're putting in there, or the length of your phone number or your email address being established, or like if you are giving an address but there is no rent or utilities or anything that is giving that applicant like a real world footprint. These are all things that would ordinarily be invisible to a person that is actually reviewing the credit application, but AI can spot like that and then use that information to at least raise questions and combat some fraud. So, there is some upside to why the lenders are using this, and it can be for the good of the consumer as well. Now, for how all of this data is obtained and used in AI underwriting, there's two ways. One is internal bank behavior. So if I am a Patelco member, which I am, and all my direct deposits, my cash flow, my spending activity, all that stuff is with my Patelco account, and I go and I apply for a Patelco loan, all of that alternative data that I just talked about is on the table for Patelco to review because it's already a part of my relationship with that institution. If I am applying for a loan at an institution that I don't already have a relationship with, then I have the option to opt into a data sharing tool that allows me to link my bank account to that lender or that application. So these are the examples of those platforms. And basically, how it works is, let's say I'm a Patelco member and I'm sitting at another financial institution and I'm applying for a loan. The application will eventually hit a screen that says something along the lines of like, connect your bank account or verify your income or whatever it is. This is entirely optional. You do not have to opt into this if you don't want to. But if you want that alternative data to be used, then you can choose to click that button. And then whatever data sharing platform they're using, Plaid, Yodlee, Finicity, whatever it is, will pop up in a secured window. And then you will pick your financial institution from the list, log in using your credentials, and then authorize the sharing. The other institution you are applying with does not get your login information. That is all handled by the middleman here, but they are essentially taking what you are authorizing them to obtain and then giving it to this new financial institution so they can then review your cash flow, your spending, your rent, all that stuff to make a more informed or nuanced underwriting decision. So that is how all of this alternative data can now be used to make a decision for yourself. If you have a thinner credit profile or your score is not necessarily reflecting what your payment capacity is, using alternative data when applying for loans can really help kind of put the tides in your favor. All right, so to put it all together, there is this three-layered model of lendability or creditworthiness or whatever you want to call it. The first layer is the credit report. This is just the raw data. So if anyone has ever looked at their own credit report, you will know that the report itself does not contain an actual credit score. That is not the job of the credit report. It is just showing whatever is being given to the credit bureau without any bias or scoring or anything. Anything that's being reported to the credit bureaus will ultimately impact your score, but the credit report itself is just the information. The second layer is the actual credit score. This is what's done with that information, and that is generate a credit score, a FICO score, a Vantage score, whatever it is. The data from the credit report is taken, it's run through whatever credit scoring model version is being used, FICO 8, FICO 10T, whatever it is, and then a score or a number is generated and given to you kind of like a credit grade. And then the third and final layer of lendability is the underwriting, and this is where you go to actually apply for new credit. They look at your credit report, they look at your credit score, which now also will include all that trended data that we just talked about. And they can also now look at alternative data and put all that information together into a big stew and stir it up and look at it to determine how they are going to underwrite your loan. So this is the model. This is the three layers of lendability, starting with all the data and how it gets trickled down to determining whether or not your loan will be approved or not. All right. I want to quickly touch on a few other changes with credit that are happening outside of kind of the new tools and models and data. And these are also things that can kind of affect the way that your credit score may be generated. So first and foremost, medical debt is now officially removed from all credit reports. This one is massive. The removal of medical debt from credit reports is now officially federal law. So the CFPB, the Consumer Financial Protection Bureau, made a 2025 ruling under what's called the Fair Credit Reporting Act, which now makes it illegal for bureaus or lenders to use medical debt in credit decisions, because medical debt is not necessarily lifestyle spending. A lot of times it's just something happened and you got saddled with this additional debt, and it's not necessarily fair to use that against you. So medical debt collections no longer appear on or affect your credit score. Next, mortgage trigger lead spam is being shut down. So if you have ever applied for a mortgage loan, I personally have not, unfortunately, not yet, maybe one day. But if you have, I'm sure you can recall how you submit one application and then all of a sudden it is texts and calls and emails galore from all these other lenders. That is because credit bureaus used to be able to sell your information as soon as your credit is pulled, and those are called trigger leads. Trigger leads have been shut down in a mortgage capacity by the Home Buyers Privacy Protection Act, the HPPA, and that officially took effect in March of this year. So now your information legally cannot be sold by the credit bureaus unless you specifically give consent. Another thing is that lenders are moving away from what's called hard score cutoff. So for example, as of November of last year, Fannie Mae removed its strict 620 minimum FICO score requirement. This is largely because of trended or alternative data. So instead of that hard cutoff, lenders are now looking more at the big picture: income, cash flow, payment history. All of that is being taken into consideration. And then last, we have increased transparency requirements for denial reasons. So if you get denied for credit, lenders now have to be clearer as to why they declined you. This change came from the CFPB's updates to Regulation B. So what Regulation B is the federal rule that basically tells lenders how they are allowed to make credit decisions. So now if a lender gives you a decline, they are legally required to tell you exactly why, like what factors, what data sources, how it affected the decision, all of that. They cannot just say you were approved because of payment activity or whatever it is. They have to specifically tell you what exact factors led to that decision. And then one more thing on this I want to talk about real quick. If you have not checked your credit report in a while or ever, annualcreditreport.com is where to go. So this is the only source for your full credit report that is explicitly authorized by federal law. Every other site that is out there is commercial or subscription based or something else. This one is the only legally mandated site that the government requires the bureaus to honor. The old rule for this pre-pandemic is that you could pull each report once a year. So Experian, TransUnion, Equifax could each be pulled once per year using annualcreditreport.com. That's why it's called annualcreditreport.com. But then when COVID hit and people's financial lives were kind of put in flux, they changed that to once a week per bureau. And then in 2023, that was made permanent. So if you wanted to, technically you could check your credit report through each credit bureau every week. I personally think that is a bit overkill, but I do suggest checking it semi-periodically, and I will tell you why. If you spot any errors on your credit report, you want to report them before they become an issue, and I am going to share a personal story about this. My first credit card I got at a college fair day was by a credit union, so luckily I did not have too high of a limit, but I ultimately had like a $2,000 spending limit. I maxed that out and just paid the minimum payments for years until I started working at Patelco and kind of learning how all of this works and decided I wanted to make a goal to pay that credit card off. So I paid it down, took me about 9 months to a year to get it all paid down to zero. And then I thought I was good to go. I had my credit card paid down to zero. My online banking was showing my balance was paid off. I thought we were golden. And then one day I pull my credit score just to, again, keep an eye on it. And I see my score had dropped like 90 points. And I was like, why is this? Everything is good. I haven't done anything, off in the last couple of months. So I went to annualcreditreport.com. I looked at my full credit report and I saw that that credit card that was paid down to zero was reflecting as 90 days past due. I was like, well, that's not accurate. It's zero. My app is showing it's zero. So I called that credit union. And apparently what happened was when I made my last payment, a couple days later, they post calculated the interest and I was charged less than 1 penny of an interest charge based on the remaining balance that I had before I paid it. So much so that it was not showing up on my app, but it was being reported to the credit bureaus. So I said, hold on now, y'all got to take care of this. And they did. They filed a dispute. They, retracted it from the credit bureaus. My score bounced back, but it took about 2 or 3 months for that to get resolved. If you are sitting at, say, a car dealership and you are looking to be approved for an auto loan and you have the car ready to go and you're ready to drive off the lot and they pull your credit and there is some error on there that is not correct that you didn't know about, but it's bringing your score down 100 plus points, I have unfortunate news for you. That car dealership is not going to wait and hold that car 2 to 3 months for you to get that handled. So you want to make sure that you spot any inconsistencies or any errors on your credit report before they become a problem, because once they are a problem, they do take a little bit of time to get resolved. All right. So in summation, with 2026, the new credit landscape, financial stability from a lending perspective now mainly hinges on these three things. Number one is consistency. So lenders want to see steady patterns. They want to see regular deposits, predictable spending, bills paid on time. Consistency tells them how you manage money reliably long term. Resilience is how you bounce back when life hits. So this is about being able to maintain some stability through things like job changes, emergencies, unexpected expenses. Lenders are looking for signs that you can recover or keep your finances on track through life's ups and downs. And then last is trajectory. Trajectory is the direction you're going in, not just where you currently are, but again, where you're heading or where you're trending. So if your balances are improving, savings are growing, debt is shrinking, that upward trend might matter more than the actual numbers that are on the page. Now, I would like to end, before I go into all of our, quick little Patelco tidbits, with another quote. If we don't empower ourselves with knowledge, then we are going to be led down a garden path. This is said by Fran Drescher of the Nanny fame. I will be honest, I did not know what the idiom to be led down a garden path meant. I thought like, oh, a garden path, that sounds quite lovely. I don't know why that's a bad thing. So I Googled it and then I learned that it means to be deceived or like tricked or misled. And I had a moment where I thought like, wait a minute, that's not what that sounds like. And then it hit me that that is in fact the point. So We do not want to be led down a garden path. We want to know what these things are so when the decisions are presented to us, we can make informed decisions. If we're ever submitting a loan and they turn that screen around and it asks, do you want to share your data? Do you want to authorize your account? We want to be able to know what that means. We want to be able to know what these questions are when they come up. So we are not led down a garden path, but we are instead led down, we'll say, a well-lit path. How does that sound? All right. So before we send you all on your way, I have a couple resources I want to share with you. You can view all of our past webinars on Patelco's YouTube channel. That QR code right there will take you to all of our webinar library. All of our recorded webinars live there. That podcast I talked about, Small Talks for a Big Change, you can listen to that on Spotify podcasts, on Apple podcasts, and I think Audible is the other one, but don't quote me on that. And again, BNPL, I forget the subtitle, but check that one out if you want to hear more about it. Spring 4, Balance, and Bonsai are all wellness platforms that we have on our website. So Spring 4 puts you in contact with community resources in your area that can help you in any kind of financial area you might be struggling with. Balance is a really great financial coaching platform. Bonsai is a really great financial education platform. I've talked about that on a previous webinar. So go check those wellness resources out. They're all for free on our website. We do have an upcoming webinar 2 weeks from today. You can scan this QR code right here to register. We'll also be sending an email out for this in the coming probably days as well, so keep your eyes peeled for that as well. But it's keys to your first home, what to know before you buy. So we are going to discuss the key steps that any future buyer should understand early, whether you're planning on shopping around ASAP or it's just something you want to know about for the future. This is going to tell you all of the information that you should know before you begin the process of obtaining a mortgage. It's going to be presented by Fred Williams, who is one of our home loan consultants. I also have a podcast episode with him out, so check that out too. I know him from years back. He used to cover the Concord area, so Fred and I go way back. I will be on that one introducing him. And again, scan that QR code there to register, or just keep your eyes peeled for that email coming out in the next couple of days. Any questions? If you need additional help, if you have any feedback for us, suggestions for future webinars, webinars@patelco.org. That email address is also where, like Megan mentioned at the beginning of this, we are going to have 3 winners of a $25 Amazon gift card. They'll be raffled off on Friday. If you are selected as one of the winners, you will receive an email from this email address that's just saying, congratulations, you're a winner. We love you. Here's $25. If you do get that email, it's not spam. It is me sitting there manually typing those letters with my cute little fingers. So keep your eyes peeled for that. And you can follow us also on socials, TikTok and Instagram @PatelcoCU. I had one last thing I wanted to say. Oh, we're going to wrap this up in just 1 second. But when we do, you are going to get a screen that pops up here that asks you to fill out a short survey. We ask this at the end of every webinar, and we really, really appreciate it. A lot of the topics that we have chosen for the back half of this year, as well as some of the other ones we've done the first half of this year, like our interactive budgeting webinar, for example, have all been because of your guys' suggestions and your feedback for future webinars. So please let us know how we did today, anything that we could work on, and anything you want to hear from us in the future. We are going to have that survey pop up on your screen as soon as we end this webinar. So I would greatly appreciate if you would not mind taking a minute or two to fill that out. Megan, how'd I do?
Based off all of the feedback, I'd say you did okay. I learned a lot. I think AI is really a tool that we're using in so many different aspects, and it's something that, as young as I am, makes me feel very old because I don't understand it. So I appreciate when things are broken down in a way that I can actually understand it. So I really look forward to the, home buying. That's another topic that is just outside of my understanding of how people can do it. So I look forward to next week.
Yeah.
And you did a great job. I always love your webinars. I highly recommend it. Anybody, if you loved what Andrew talked about, jump on our podcast. It's award-winning. Andrew is incredible, and there are subjects for everything from student loans to just living more normally in everyday life. So it's not just our webinars. Definitely check out some of our other resources because Andrew is a tool that we have, and he's incredible.
Aw, thank you, Megan. I appreciate you. Thank you all for spending your Wednesday evening with me. Thank you for attending. There's that email one more time. My name is Andrew. I appreciate our Wednesday evenings together, and I will see you in 2 weeks on July 22nd. Have a good evening. Hey, you guys, hope you liked that video. Thank you for watching. For more financial wellness information, go ahead and click here to subscribe and here to watch the next video. Thank you.